With trouble flaring up in the Middle East, spiking oil prices, and skyrocketing inflation, the U.S. is facing a flashback to the 1970s era stagflation economy characterized by stagnant economic growth, high unemployment, and simultaneously high inflation. Now, stagflation is when the economy slows but inflation keeps going up. You try to boost economic growth and inflation gets worse. You try to fix the inflation and the economy constricts further. There's no easy fix except for essentially to break the entire system with a major recession and economic pain and start over from scratch. Now, Jamie Dimon, CEO of JP Morgan Chase, is warning of coming stagflation. His forecast is tied to his belief that we will see interest rates exceed 7%, which will have a devastating effect on the economy. His worries come from the impact that higher interest rates will have on debt repayment. Higher interest rates makes repaying debt more expensive, adding financial stress to individuals and businesses. And when interest rates rise significantly, the risk and number of loan defaults also increases. Deutsche Bank also fears a return to the 70s-style stagflation, with parallels arising such as unrest in the Middle East, anemic growth, stubborn inflation, and labor unrest. Between 1973 and 1983, GDP rates plummeted. Inflation averaged 11.3%, and there was an oil price shock caused by war similar to what we see today in the Russia-Ukraine war and further conflict in the Middle East. And these supply shocks can have serious difficulties for the economy. Now, the number of striking workers is also on the rise in a repeat of the 1970s. You have actors, screenwriters, auto workers, journalists, and more which have taken steps to push for higher wages to compensate for inflation. And 50 years ago, workers struck to raise wages 9% annually, but some economists believe that the persistent wage increases contributed to higher inflation and fear that current worker strikes could do the same. U.S. inflation is also back on the rise again for 2 consecutive months in August and September, and new price shocks could easily set inflation expectations soaring, leading consumers to further restrict their spending, their saving, and their investing. Now, add to that the sluggish rate of economic growth, and tighter financial conditions have begun to take a toll on the economy, and there's little room for that to change. Deutsche Bank concludes that the last stretch of the Fed's inflation war is likely to be the hardest. As inflation inches closer to its target, markets are putting more and more pressure on the Fed to slash interest rates altogether. Higher borrowing costs, though, are weighing heavily on asset prices, and factoring in the lag between rate hikes and their effects, there's a risk that the Fed could plunge the economy into recession. But if the Fed stops too soon, inflation will persist, and the country will find itself back in the middle of a stagflation crisis. With economic indicators pointing to a repeat of the stagflation that plagued the 1970s, preparation is key when navigating economic uncertainty. If you're concerned about the coming recession and you're looking for a way to minimize risk, I'm Mackay Block with American Hartford Gold. Give us a call today to discuss how putting physical gold and silver into your portfolio or into your retirement account can give you the hedge that you need.
Discover how gold can help you protect yourself and your family. Call today or visit our website for more information at AmericanHartfordGold.com.